Welcome to the deep dive, where we trying to cut through the noise and get straight to the insights. This week, the headlines have just been blazing, exhilarating news. The S&P 500 hitting another fresh record high. It's extending one of its longest weekly winning streaks in 3 years. It really feels like the market can do no wrong right now. But yeah, is this rally really a sign of a robust economy, or are there maybe some hidden currents we should be watching? Today, we're going to dig into an analysis by Lance Roberts from RIA Advisors. It's called Retail Data Sends a Warning, and it offers a pretty critical look at all this market euphoria. So our mission here is to really unpack this apparent contradiction. You've got record markets on one hand and maybe some less than rosy economic signals underneath. We'll explore what's fueling it, where the warning signs might be, and importantly, what it all means for you. Okay, let's jump in. So looking at the big picture, that S&P closed at 6,388.64. Wow, it certainly paints a strong picture. You mentioned it's fueled by strong tech earnings, hopes for Fed cuts, lots of liquidity. Seems resilient.
But what's really driving this? And are there any red flags you're seeing beneath that shiny surface?
Yeah, it absolutely looks strong on the surface. And what's really striking is something like 87% of companies reporting through Thursday actually beat expectations, mostly in industrials, financials, healthcare, tech.
87%, that's huge.
It is. But, this isn't necessarily a sign of broad economic health. It might be more an indicator of concentrated optimism, sentiment. Investors are really betting on inflation cooling without hurting profits. That belief is strong, and we're seeing other signs of that sentiment. Volatility is down, the VIX below 15.
Right.
And just record speculation in those really short-dated options, the zero DTEs.
Zero-day options, yeah, high-risk stuff.
Exactly. Zero-data expiration, high-risk bets expiring the same day, all classic signs the market's running more on sentiment maybe than pure fundamentals right now.
Okay, so if sentiment's kind of taking the wheel and valuations are hitting historic highs again, prices climbing faster than earnings, what's that tell us about the market's mood?
It tells us optimism is, it's running hot, maybe even overheating a bit. Now, valuations themselves, they aren't a perfect timing indicator, right? But seeing them surge back to previous highs like this, it definitely signals very high expectations are baked in. And the technical signals, they sort of echo that warning.
How so?
Well, take that correction we had back in April, remember, about 20% down.
Right, yeah.
That was actually the 7th successful retest of the 36-month moving average since the global financial crisis. Each one of those tests, going back over a decade, marked a point where the long-term bullish trend held up. Investors stepped in.
Okay, so that suggests the underlying long-term trend is still kind of intact?
Exactly. It suggests that the secular bull market is still there. Long-term buyers are still present during those big pullbacks.
So the market's shown this incredible resilience bouncing back. But you mentioned other technicals. Are they confirming this strength or maybe flashing different signals?
Yeah, this is where it gets really interesting. Despite that long-term resilience, the monthly RSI, the Relative Strength Index.
Measures speed of price changes?
Right. It's back in overbought territory, 71.5. That often suggests a rally might have gone too far too fast,
Okay.
And the MACD indicator, which tracks momentum, it's starting to flatten out, like a car losing acceleration. Think of it like you're driving your car, right? Everything feels smooth, you're cruising, but the gas gauge, it's ticking down towards E.
Right.
You can keep going for a while, sure, but you'd better have an exit plan mapped out because that fuel won't last forever.
That's a great visual. Running on fumes, even if the ride feels smooth. And maybe that gas gauge is most critical when we look at the U.S. consumer. We've seen different takes on this, haven't we? Like Yahoo Finance saying they were hunting for signs of consumer rot but didn't find any. They basically said, as goes the consumer, so goes the economy and the market. Seeing the consumer as solid.
That's definitely one perspective, and it's a common one. But Lance Roberts, in this piece we're looking at, he offers a really compelling counter-argument. He digs deeper into the retail data.
Okay.
And while, nominal retail sales showed a 0.6% increase recently, which sounds okay, the crucial thing is the real inflation-adjusted retail sales. They've actually been flat, stagnant, since all that stimulus spending back in 2021.
Flat, really, after adjusting for inflation.
Flat. So, despite the headline number, once you factor in inflation, it's far from what you'd call a strong report. It paints a very different picture of what consumers are actually doing.
And Roberts points out that periods of flat, real retail sales like this, they've often happened right before or even during recessions in the past. So that raises a big question for us. Why does this real retail data matter so much for the market, for corporate profits?
It's fundamental, really, because corporate earnings, they come directly from consumer spending. Think of consumer spending as the fuel for the corporate engine. It drives company revenue, the top line on the income statement. That revenue translates into profits, which, ultimately supports stock prices. If consumers aren't spending robustly, revenue growth slows down, and eventually profits suffer. It's a direct link.
And this brings us to PCE, right? Personal consumption expenditures. That's a broader measure than just retail sales.
Exactly. PCE covers nearly 70% of the economy. Retail sales are only about 40% of PCE, so it's a much bigger slice.
So what's the link between this broader PCE measure and where corporate earnings might be headed?
Well, historically, the annual change in forward earnings estimates tends to track the annual change in PCE pretty closely. The correlation, for those who like the numbers, is just over 51%.
Okay, so better than a coin flip. A decent connection.
Yeah, it's significant. It tells us there's a real historical link. When consumer spending, as measured by PCE, goes up or down, corporate profits tend to follow suit, maybe with a bit of a lag.
So what does this all mean then, if we're seeing this potential rot, as Roberts calls it, in the real retail data?
It suggests consumer spending might be weakening under the surface, and that could be a major threat to the market rally because it hits future corporate profitability. The consumer really is the fuel. If that fuel supply starts to dwindle, the market engine could definitely sputter.
Wow. Okay. That really puts a different spin on this market climate. It feels like such a paradox. The index is up, 8.6% year to date, 28% since that April low, one of the fastest climbs ever. And this is happening despite all these headwinds we know about: tariffs, slowing growth, high rates, sticky inflation, less monetary support. Like Spencer Jacob at the Wall Street Journal said, the market rallied for reasons nobody understands and nobody predicted. It almost seems too good to be true.
It's precisely that sort of unexplained strength that's, it's puzzling and maybe a bit concerning.
Yeah.
And a huge factor here, connecting back to the market structure, is the incredible concentration we're seeing, especially in tech.
Right. You mentioned that earlier.
Yeah. Goldman Sachs pointed out the U.S. infotech sector is now about 34% of the S&P 500's market cap. That matches the peak back in 1999 to 2000.
34%. Just tech.
Just the infotech sector. And get this. That one subsector, at around $18.5 trillion, is bigger than the entire stock market of every other country outside the U.S.
That's staggering.
It is. And think about the risk there. If that one highly concentrated sector reverses course, the ripple effect on the whole market, the broader index, would be massive, disproportionate.
And it's not just concentration. JP Morgan's seeing extreme crowding in high beta stocks. What does that mean exactly?
High beta stocks are basically those that are more volatile than the overall market. They move up faster in rallies, but also fall harder in downturns. JP Morgan says the crowding into these stocks is in the 100th percentile historically, and it's happened at the fastest pace in 30 years.
Wow, so everyone's piling into the riskiest names.
It looks like a lot of speculative money is chasing momentum, yeah. A speculative frenzy.
It reminds you of those cautionary tales, doesn't it? Like Roberts mentioned CNBC launching that Next Generation 50 index for millennial and Gen Z stocks.
Right. And the timing on things like that is often revealing. History is just littered with these thematic indexes or products launched right near market peaks. It's often a sign of excessive psychology,
And that article about the CNBC index came out December 2021?
Exactly. Just 1 month before the market peaked in early 2022. It's almost like a contrarian signal sometimes.
We're seeing technical signs of this exuberance too, right? Like the NASDAQ 100.
Yeah, the NASDAQ 100 went 60 trading days without closing below its 20-day moving average. That's the second longest streak since 1985.
And the longest one ended
Early 1999, right before that tech bubble burst.
Oof. Okay, and the S&P 500.
It just had 18 trading sessions in a row without a single 1% move up or down. Longest calm stretch like that since December 2024.
Right.
Wait, no, that can't be right. The source probably meant December 2017, or a similar period. Let's just say a very long time. Low volatility, high complacency.
So all these signs, concentration, crowding, historical parallels, these technical streaks, they scream bullishness, maybe too much bullishness.
Critically, yeah. None of this guarantees an immediate crash. Let's be clear about that.
Right, not predicting.
Not predicting. But it absolutely gives us insight into the current level of, exuberance, froth, maybe. The simple truth really is, if everyone is buying, eventually, you run out of buyers. And when sentiment shifts, things can change very, very quickly.
That idea of running out of buyers,
Yeah.
it makes me think of that analogy Roberts uses, the crowded theater.
It's a powerful one, isn't it?
Yeah. Everyone's enjoying the show, it's fine. Until someone yells, fire! Then it's chaos trying to get out the narrow exit.
That's exactly the market scenario he's painting. When the robot trading algorithms, these automated systems reacting to market signals, when they start to reverse course, maybe triggered by some unexpected news or a technical break, they don't think, they'd just sell all at once.
A stampede.
A stampede. With zero regard for price or fundamental value, that triggers margin calls for leveraged investors, forces more selling.
Indiscriminate selling.
Exactly. And you get these huge catastrophic gaps between what buyers are willing to pay and what sellers are asking for, especially in things like ETFs. Prices just plummet.
And investors are just watching their gains evaporate. Helpless.
Helpless on the sidelines, watching capital appreciation vanish in moments.
Yeah. And Roberts mentioned he warned about this back in 2017 in a piece called Rise of the Robots.
Yeah.
It was early then, but...
But it proved prescient in 2020, didn't it? When the pandemic hit, someone effectively yelled fire, and we saw that algorithmic cascade.
Right.
And his point now is that retail investors, maybe drawn in by the rally and the meme stock stuff, have crowded back into that same theater, believing prices only go up.
Sounds like a risky setup.
It is, and that's why he and his team are, in his words, sitting closer to the exit. Not out of the market necessarily, but positioned more defensively. Risk levels just feel elevated with valuations stretch and these signs of technical exhaustion popping up.
Okay, so how do you navigate this? You've got this high exuberance, meme stocks are back, zero-day options are flying, but the underlying data, like consumer spending, is flashing yellow. Roberts says the key is participation with discipline. What does that actually look like? What are some practical tactics for investors listening?
Right, it's about staying engaged, because you don't want to miss out entirely if the rally continues, but doing it smartly, strategically, without taking on foolish risks. So, a few things you can consider.
Okay.
First, maintain a quality core. Anchor your portfolio. High conviction companies, strong balance sheets, good cash flow, solid earnings, your foundation.
Makes sense.
Second, limit the speculation. Don't go overboard on the high beta momentum stuff. Maybe 5-10% of your portfolio max in that tactical sleeve. It's your play money, not your core retirement fund.
Right. Keep the gambling small.
Pretty much. Third, think about using options strategically. If you have positions that have run up a lot and seem overbought, maybe sell covered calls against them to generate some income.
Collecting premium.
Exactly. Or consider protective put spreads on the indexes, like STY for the S&P or QQQ for the NASDAQ. It's like buying insurance against a sudden drop.
Okay.
Fourth, tighten your risk controls. Look at your positions that have had big runs. Maybe raise your trailing stops or set clearer profit targets. Locking in some gains isn't market timing, it's just prudent risk management, protecting profits.
Good point. Don't let winners turn into losers.
Exactly. Fifth, maybe raise some tactical cash. Having 10%, maybe 20% in cash gives you flexibility. When volatility comes back, and it likely will, you'll have dry powder to buy things at better prices.
So cash isn't trash, it's a strategy.
Dry powder is definitely a strategy, not a missed opportunity. Sixth, monitor the sentiment extremes. Watch things like positioning data, put-call ratios, the VIX. When speculation gets really frothy, maybe it's time to do less, not more. Don't get swept up.
Resist the FOMO.
Resist the FOMO, exactly. And finally, number 7, don't chase, rebalance. If certain sectors like AI or whatever the hot thing is have just gone parabolic, use that strength. Trim those positions. Rebalance into areas with more reasonable valuations, maybe more stable growth. Keep things in balance.
So the goal isn't really to skip the party altogether.
No, not necessarily. It's just making sure you're positioned smartly, maybe closer to the exit, for when the music eventually stops.
Okay, so recapping here. We've looked at this soaring market, which is exciting on the surface, but it comes with these clear warnings. Real consumer spending isn't as strong as nominal figures suggest, and there are undeniable signs of excessive speculation and concentration.
Yeah, and what's fascinating or maybe confusing is that the market's technical structure seems to be improving underneath, which might actually reduce the risk of a really severe crash in the coming months. But that short-term risk, 5% pullback, something like that, just to cool things off from these overbought levels, that risk seems to be increasing.
Right. So bring it back to you, the listener. Given this deep dive into the market paradox, record highs versus these subtle but critical warnings from consumer data, the signs of exuberance, here's a thought to mull over. What specific areas of your own financial strategy might be unknowingly vulnerable to that crowded theater effect we talked about? And maybe what's just one single tactical adjustment, like the ones we discussed, could you consider making today to gain a bit more discipline and get better positioned for whatever might come next? Lots to think about. Thanks for joining us on the Deep Dive.